Insurance. You know, the word alone can make you think of all this confusing paperwork and tiny, tiny print. But what if I told you it all pretty much boils down to just 3 simple rules? Well, in this explainer, we're going to do just that. We're going to demystify insurance, breaking down the core principles that run through everything, from your health coverage all the way to your car policy.
All right, so here's our game plan. We're going to kick things off with the 3 golden rules that really, they apply to every single policy out there. And from there, we'll see how these rules play out in the real world. You know, for our health, our stuff, our businesses, and even for society as a whole.
So let's jump right into the most important part, the executive summary. We're getting the 3 golden rules of insurance out of the way first. Seriously, if you can master these, you'll have the key to understanding pretty much any policy you ever come across.
And here they are: indemnity, proximate cause, and utmost good faith. I want you to think of these as the 3 main pillars that hold up the entire insurance industry. So let's take a closer look at what each one of these actually mean.
Okay, first up, indemnity. This is a huge concept. Insurance exists to put you back in the same financial spot you were in before something bad happened, not to make you better off. You just can't profit from a claim. It's why personal accident policies, for example, often cap the payout at, say, a multiple of your salary. The goal here is restoration, not hitting the jackpot.
Now, our second rule, proximate cause, it gets into a bit of a trickier question. What was the real reason for the loss? To get our heads around this, just think about this exact scenario. What do you think? Was the accident the direct cause of death here?
Okay, let's look at the 2 different outcomes. In the first case, you've got this direct, unbroken chain of events, right? The fall led to the exposure, which led to the pneumonia. The claim would most likely get paid. But in that second case, the hospital infection, well, that's a new, separate event. It actually breaks the chain of causation, which means the accident itself is no longer the proximate cause of death.
And this really gets to the heart of it. Insurers aren't just looking for any connection. They are trying to find the single, dominant cause. It has to be the most powerful and direct link in that chain of events that led to the loss. And that's exactly why the specific little details of any incident are so critical.
So, our third and final rule, it's all about honesty. Simple as that. An insurance contract requires utmost good faith, which means you and the insurer both have to be completely transparent. If you don't disclose something important, like a pre-existing medical condition, or maybe the fact you use your car for work, your policy could be totally voided when you go to make a claim. In this world, honesty is quite literally the best policy.
So now that we have those 3 rules in our toolkit, let's see how they actually apply in the real world. We'll start with the policies that protect our most valuable asset, our life and our health.
You know, personal accident policies aren't just about a death benefit. They really provide a financial safety net for a whole range of things that could happen. This includes those catastrophic events, like losing 2 limbs, but also partial disability, like losing 1, or even a temporary disability that stops you from working and earning an income for a while. And here's a pretty cool feature that actually rewards you for staying healthy. This cumulative bonus, it kind of acts like a loyalty program. For every single year you don't make a claim, your total coverage amount goes up by 5%. And that can get up to a 50% boost over time, all without you paying a penny more in premiums.
Now, health insurance, that's what kicks in for the medical bills. This covers the really big ticket items, like your room at the hospital, surgeon's fees, medicines, but it also covers what are called daycare procedures, things like chemotherapy or dialysis, where, because of modern tech, you might not even need to stay overnight. So when it's actually time to use your policy, you're usually going down one of 2 paths. With a cashless claim, the hospital and the insurer talk directly, so you don't have to pay anything up front. With reimbursement, you handle the bills first and then you file for repayment later. Knowing which one your hospital supports is absolutely critical in an emergency.
Okay, so we've covered our health. Now let's talk about our stuff. How does insurance actually go about safeguarding your home and your possessions?
So you might think these words are basically interchangeable, right? But in an insurance policy, they are defined so precisely. The difference between theft and robbery is the use of force. The absolute key for burglary is forcible entry or exit. Think a broken window or a busted lock. And dacoity, which you might not have heard of, is really just robbery committed by a large group. For a claim to be valid, what happened has to match the specific thing covered in your policy.
Now, insurance isn't just a personal thing. It's a fundamental tool for the business world. It protects companies from all kinds of risks that could, well, threaten their very existence.
One of the biggest risks a business faces from the inside is employee dishonesty. Fidelity Guarantee Insurance is designed specifically for this problem.
It covers direct financial losses if a salary employee commits fraud or embezzles money or messes with the accounts. It's basically protection from the inside out.
But, and this is a big but, insurers won't just hand over this kind of coverage. They need to see that the business has really strong internal controls in place. Simple things, like requiring 2 signatures on payments, doing surprise audits, or making daily cash deposits. It all shows that the company is serious about preventing the very risks it wants to insure against.
This flowchart, it highlights a universal truth in insurance. Process and documentation are absolutely everything. It might seem like a kind of a weird example, but the principle is exactly the same whether you're insuring a tech startup or a chicken farm. A clear claims process and having the right paperwork, that is completely non-negotiable.
Okay, for our final section, let's look at something really fascinating, how the principles of insurance can be used on a massive scale to achieve broader goals for society and protect the most vulnerable people.
How much do you think you'd pay for a whole year's worth of accident insurance? What if I said 20 rupees? That is the incredibly low annual premium for the Pradhan Mantri Suraksha Bima Yojana, which is a government-backed insurance scheme in India. For that tiny premium, this scheme provides a really significant safety net. It offers coverage for accidental death or total disability and a smaller payout for partial disability. And by using the banking system for automatic payments, it makes basic accident insurance accessible to millions and millions of people.
And the applications, they don't stop there. Policies like the Bhagya Shri scheme are super targeted. They use the mechanism of insurance to solve a very specific social problem, making sure a girl's education isn't ruined by a family tragedy. It just goes to show you how versatile insurance can be as a social tool.
So there you have it. From those 3 golden rules to policies that protect entire communities, insurance is really, at the end of the day, a tool for managing uncertainty. As we leave you with this final question, we hope this explainer has given you a much clearer way of thinking about the risks in your own life. Thanks for watching.